Hey guys, Taylor with GammaEdge coming at you with a post-market recap for March 28th, 2025. Session can be recapped by another brutal day for the bulls, had a gap lower and a sell-off throughout the session. So we're going to recap for you our pre-market analysis in terms of structure, key levels, and momentum in the market, and then what our intraday tools were telling us in terms of why this downside continuation was continuing throughout the session. So just a bit of context for you here is SPX daily chart. You can see it had a big waterfall lower since the middle of February. Those of you not in the community, during this time period saw an erosion of call speculation in the complex. Puts came in, we're starting to dominate market trend model, which we'll get to in a second. Rolled over to the downside, large sellers were stepping in. Then we got this little, now it looks like a dead cat bounce, simply just a lower high. But again, during this time frame, we were talking about how we never saw that call speculation meaningfully come back into the complex. And then our market trend model rolled over as well. So all that to say, puts are in control, and the bulls are guilty until otherwise proven. So again, pre-market plan, we're going to go through our pre-market newsletter we send out at the beginning of each session. This is free, GammaEdge.us/education. This is where you can sign up for it. We send you key events for this week in terms of economic conditions, company earnings, a whole bunch of different sentiment indicators. Then we send you visualizations of the SPX complex, both the full structure and 0 DTE. Then we send you a couple of Mag 7, dashboards. We send you scan results for our call and put dominated scans. And then, kind of an update of our P-Transit plus SPX 100% mechanical strategy. But enough of that, getting into the market trend model. So this was at the open on Friday. Again, we're talking about the rollover that we saw on Wednesday into Thursday. Again, that was met with large selling. Just backing up the market trend model, this is built off the tick index. If you don't know what that is, you can go to Investopedia, learn about it real quick. Effectively, though, what that's measuring is the real-time buying and selling in the market. If stocks are making an uptick, then the tick index is going to move higher. If stocks collectively are making a downtick, then the tick index is going to move lower. And understanding the direction and the angle of that direction, we can infer, the significance of the buying and selling taking place. So Thursday is an example. This is a waterfall, linear down day. There's significant selling taking place. Further, our filter tick, which is this bolded cyan line, this measures ticks when we have plus or minus 1,000 tick readings. This is a general benchmark accepted by the industry. So again, Thursday, we saw significant selling taking place. Sorry, this was on Wednesday. And then Thursday, we didn't see any improvement in the tick itself. We continued to trend lower. No, there was not as significant of selling as there was on Wednesday, but net there was still large selling, and the market breadth continued to deteriorate. This measures 52-week new highs versus new lows. Red was much higher than the green, so again, new lows significantly outpaced new highs. So again, based off this single factor in our model, the bias was certainly to the downside. Next, what we do is then we go look at SPX options market structure and positioning in itself. The reason that we do this is the options market is inherently forward-looking. So rather than looking at a price chart that is based solely off what's happened in the past, we can understand how speculators are positioning based off their forward-looking expectations. Second reason that we focus on SPX is because it's the largest options market and is a great representation of what the crowd is thinking. Additionally, one unique thing about SPX is there's two components of it. There's SPX-A, which is the AM settled contract, SPX-P, which is the PM settled contract. The AM settled, we think of that more as your cruise ship. Reason for that is because that is your monthly and your quarterly expirations. Again, so these are longer term in nature. So we equate that to where longer term capital, institutional capital are putting positions on. And then SPX-P, that is more of your cigarette boat. By that, we mean that's where your 0 DT and your weekly expirations are occurring. And this is more shorter term speculation, and those contracts turn over a lot faster. Again, and keep in mind that 50-60% of daily SPX options volume is transacting in the 0 DT complex. So coming into Friday, this was the SPX-A complex. Things to point out, looking at the complex itself, put speculators were in control above and below spot price. So this kind of confirms what we saw in the market trend model in terms of, remember, that trend was lower. Puts were in control, so those we're seeing confluence between those two. And just so you can see an example of what a more healthy and constructive market structure looks like, Here's one that is call dominated, right? You can see all the green here, clearly a call dominated structure. Again, flipping back to current day SPXA, that is clearly a massive difference in terms of red everywhere. So again, even if you had our market trend model and just SPXA, those two factors alone would let you know that if you're trying to be bullish here, that's probably not the ideal point of view. And we want to see that this structure start to thaw out in terms of call speculators coming back into the complex, put speculators leaving, and the market trend model turning higher. This would suggest to us a lot better of a turning point in the market and a reason to believe that we could see a sustained move higher. However, clearly not the case right now. Moving to SPXP now, remember this is our cigarette boat. This is where the 0DT weekly contracts are housed. Sorry about that. And so again, the main points here, we are in a put dominated structure. And in terms of key levels, we think of it in terms of transition zones. The transition zones you can think of as areas in the option structure where there is congestion between call and put dominated strikes. The key transition zone for you here is highlighted in the purple box, which was 57.25 to 57.55. This is based off a delta or distribution of calls and puts in the structure. Below this level, and puts are more in control of the structure above this zone, and calls are more in control of the structure. And it's critical that you understand that this transition zone and where spot price is, because price itself can turn a lot faster than the structure. And by that, I mean this structure coming in today was clearly put dominated. However, if we were to push above 57.55, this would indicate to us a potential turning point in the market to where now we are more in a call dominated environment. So we would expect to see that calls start to come in the market, or at least puts start to remove themselves from the market. However, we know that we, significantly were gapping down from the bottom of that transition zone Friday at the open. So again, from a longer term point of view, from a swing trader point of view, there's really nothing telling us that the move was to be bullish on a multi-day, multi-week time horizon. Just going through the fundamentals again with you guys real quick on that rationale. The market trend model was moving lower. SPXA put dominated, SPXP put dominated, and below our key transition zone. So with that, if you're a swing trader, that's good enough to tell you, okay, still not a favorable market. Let's go outside and do something else. Save that emotional capital for when conditions are a lot more favorable. But then we also shift our attention to SPX 0DT because the GammaEdge, that is a big focus of ours, because that's a big focus of the market too, right? And a lot of people make their living specifically, trading intraday. So looking at 0DT structure coming into Friday at the open, we were put dominated above spot price, call dominated below spot price. That is not unusual. That's typically what the structure looks like. Next, we move to our transition zones. The delta gamma transition zone was from 57.30, 57.35. So again, from a bullish point of view, we want to get above 57.35. Again, we are gapping well below that level. And then we also focus on something that's specific to the 0DT complex called the drunken sailor range, which is based off the distribution of call and put speculation, which you can see right here in our web app. And the whole theory behind the drunken sailor zone is that there are low pressure pockets in the structure to where while, puts could be in control here, there's not a significant influence from them. So this is really where intraday call and put activity, the physical opening and closing of transactions, can have a lot bigger influence on driving price than the mechanics of options moneyness, dealer, market maker, hedging dynamics. So this really captures for us where those key points in the market are, to where if we can overtake those goalposts, then those dynamics can really start to have a bigger impact on spot price itself. So that zone coming into today was 57.40 was the top of our drunken sailor zone. 5,700 was the bottom of our core transition zone, which again is also a whole cycle level, 5,700. Then you'll see that we also had an additional air pocket from 5,700 down to 5,675. And again, intraday volume analysis, which if you've been watching these recap videos for the last couple of weeks, that is critical when trading intraday. Because remember, even if we have a structure in place, the actual buying and selling that takes place intraday can overwhelm any type of structural setup. Further, what I want to hit on real quick, this is called our NetStat tool. And I know that there's a lot of data in here. However, it's pretty simple. You can think of this. This is another visualization of what the options market structure looks like in terms of who is winning the battle between call and put speculators as it relates to the four key Greeks. Remember that delta is first order Greek, all these other ones are second order Greeks, meaning that they influence delta. So having said that, looking at delta itself above spot price, we could see that in the money puts were in control, below spot price in the money calls were in control. We just went over that at the beginning. That is generally the setup that we see. However, we can see the magnitude is significantly higher in terms of put delta relative to the in the money call delta. So what that means is all things equal, if spot price wasn't to change throughout the rest of the session, those in the money puts, which were a lot more significant, those are going to continue to limit to -1, introducing more negative delta into the complex. And those in the money calls, which are dominant below spot price, are going to decay to 0. So again, now you have in the money puts pushing down, in the money calls pushing up, but the magnitude of those in the money puts are significantly more. So that's a massive weight on the market. The reason, again, why that's important, why this tool does a great job of kind of encapsulating everything is because, again, SPX complex, we were well below the transition zone, and B, we have a massive weight on top of us. And then also, with the larger dynamics of the market trend model and in the full SPX A and peak and P complexes. One other thing to note is that the implied open was significantly below all of our transition zones. So the risk here is that all of these put positions that were in place when we open the market, they are going to be in the money now. Meaning from when they were originally put on to where spot price is now, they captured all of that out of the money risk. So the risk now is that they monetize those positions. So again, this is where understanding what is actually transacting intraday is going to be critical on a day like this. Because again, the rubber band relative to the transition zone is significantly stretched. So again, mean reversion is not a crazy thought here. However, we want to see intraday volume and ultimately price action to either confirm, yes, this is happening, or no, we're going to continue to see speculation transact lower on the day, which is what we got. So here's price action on the day. We have our transition zones, both the drunken sailor and the GEX transition zone drawn out for you guys here. We can see price, gap down below, then we just trended lower the entire day. Like to mark out these other key levels, which these are the key psychological levels, this being 5,600, 5,650, 5,675. Looking back to the dashboard, the reason we mark those is because there's a significant amount of delta and gamma packed at these levels. So, understanding if we are, either bouncing at these levels or further, slicing through these levels is very informative because of the moneyness of those options. Meaning 5,650 is an example. Put dominated strike. We're able to, if as price sliced to that strike, all of those out of the money puts became in the money. Now they start limiting to -1, which introduces more downside delta into the complex. And so this is where we get to our intraday volume analysis. Quickly going through this chart if you're not familiar with it yet. So what we do on a 5-minute by 5-minute basis intraday is for the SPX 0DT complex, again, because that is where a significant amount of transactions are taking place. We look to understand what the put and call speculators are doing. So what we do is we aggregate all volume for a 5-minute time frame. We understand the distribution of that volume, and we find the centroid, which is effectively the middle point of that distribution. What we do is we plot those throughout the day on a 5-minute basis, both the call side and the put side. We connect the dots for you, and we create this chart. And so again, this chart helps us at any point in time throughout the session. Just keep in mind, this is the end of the day session, but we'll go review an intraday one as well so you can understand the utility of it. It tells us the behavior of how those call and put speculators are transacting. So like this, for example, call speculators were transacting lower all throughout the session. So there's no reason really to expect we're going to see any type of meaningful move higher, because when we do, we see a ramp higher in the call speculation or ramp higher in the put speculation. Clearly, we did not see that at all. And in terms of the put side, this was fairly flat to lower on the day. So again, no reason really throughout the session to see that there is any meaningful type of monetization from the put side. So again, really no type of sustained rally higher should have been expected. So here's an example what the volume chart looks like. This was at 11:10 a.m. We can see from the open until this time, call speculators, they were speculating lower, put speculators, again, speculating lower. So we can infer that based off of this time period, what we do is we then, just simply draw a linear regression, which is this dashed line, and it tells us all things equal, these speculators are going to continue to speculate on this on this path. Same thing to the downside with the put side, and price is going to move here. Here being down here. Obviously, if you're new to this, you're probably thinking, okay, so we're projecting price is going to, collapse 300 points. No, not exactly. Keep in mind that we've been trading for an hour and a half at this point, and each new data point at this time is going to have a significant impact on the lines of best fit. So eventually, these lines of best fit are going to start to level out. However, this is, telling us without a doubt that the speculation continues to be lower. So, if you're going long here, hoping for some kind of sustained move higher, that is not the play, because there's nothing suggesting that. Remember, price does not go where transactions are not taking place. So if you want to see a move back to 5,700, then what we want to see is a ramp higher in that call speculation and a ramp higher in that put speculation. So again, fast forwarding, here is the vol M from a couple hours later. This is at 1:30 Eastern time. We can see that from the call side, this has continued to trend lower. Put side, this has continued to trend lower. However, keep in mind, the ending point is no longer at 5,300. Again, as I was saying, you can see that the angle of descent of the calls and the put side has, eased. However, nonetheless, it is still trending lower. So here we are at 3 o'clock Eastern Standard Time, an hour before the bell closes. Again, we can see the character of the day has not changed at all at any point we reviewed, whether it be 11, 1:30, or now 3. The call side has been trending lower all day. The put side has been lower to flat on the session as well. So again, this was a really good guide to tell you the potential price path at 11 or 1:30 of where price could be headed. Whether that means scalping once we get kind of bounces higher, playing for a downside move, or if you're selling credit spreads, selling on the sides of the centroids. Either way, this tool is incredibly useful for that. And then again, something useful that we do is at the end of the session, what we do is we stitch together all of those 5-minute slices of the vol M command. And this is just a great way of understanding how each new centroid plot can inform how those lines of best fit, which are the projected price path, how those can impact that. And then also just understanding, looking at the day in general, how we continue to see that call speculation move lower on the session, put speculation move lower to flat on the session as well, and ultimately how price fell with in between those kind of guardrails as well. So with that, hopefully made it clear how we use our tools to understand, price momentum, which is the market trend model. We understand through our pre-market plan of, the battle between call and put speculators, where those key levels in the structure are. And then lastly, using the intraday price analysis to kind of confirm that structure, to understand how those speculators are transacting on the day, which ultimately can inform our trades for the day. So with that, you'll have a great rest of your weekend, and we will see you back here on Monday. Thanks. Bye.